Welcome to the deep dive. Today, we are digging into Snowflake's first quarter results. This is for their fiscal year 2026, the quarter ending April 30th.
Right. And we've got the investor presentation, the press release, the official stuff.
Exactly. So our mission really is to unpack these numbers. What's the story behind them? Especially thinking about their AI data cloud push.
Okay, yeah, let's get into it. A few things kind of jump out immediately. Product revenue, for instance, almost hit $1 billion, $996.8 million. That's up 26% from last year. Pretty solid.
26%, yeah. And what else?
Well, the net revenue retention rate, NRR, always a big one for SaaS, well, consumption models too. It's sitting at 124%.
Wow, 124%. So existing customers are spending quite a bit more.
Exactly. It signals loyalty, expansion, real stickiness. And then there's the big spenders, customers doing over $1 million a year in product revenue.
How many of those now?
606. That's up 27%.
Yeah.
So more large customers are really committing.
Okay, so these aren't just numbers on a page. They give us a sense of how a data and AI-focused company is, well, navigating the current market.
Right. And you mentioned RPO, too, remaining performance obligations. $6.7 billion. That's a big pipeline number.
It is. It signals future contracted revenue, which is always good to see.
So let's break down that revenue first. Total revenue also hit $1.0 billion, also up 26%.
And most of that is the product revenue we talked about, the $996.8 million.
Exactly. That comes from customers actually using the platform, compute, storage, data transfer, consumption.
Right. And they make a point that this product revenue is a leading indicator for them. Why is that important compared to, say, a subscription model?
Well, because it's tied directly to usage. The more value a customer gets, the more they use, the more they pay. It's not fixed like a subscription.
So it reflects real-time activity and value delivery. Makes sense.
Now, let's look at the customers themselves. Total count is up to 11,578.
Which is, what, about 19% growth year over year?
19%, yeah. And within that, the Forbes Global 2000 group, the big names, that reached 754. Slower growth there, about 4%.
Okay, but that 124% NRR, that really tells a story about the existing base, doesn't it?
It really does. I mean, on average, customers are spending 24% more than they did the year before. That's strong.
So what do you think drives that? Is it just more data? Are they using more advanced features, AI stuff perhaps?
It's likely a mix, right? The platform probably becomes more embedded. They scale up data projects, maybe start using analytics, AML features more, which, ties right into that AI data cloud story they're telling.
And how they calculate it is interesting too. If a customer stops using it in year 2, they count as 0 for that year.
Right. So getting 124% means usage is really consistent and expanding significantly among those who stick around.
Okay, let's circle back to that RPO. $6.7 billion, up 34% year over year. That's a hefty increase in future contracted revenue.
Huge jump. It's basically their backlog.
And they expect to recognize about half of that, roughly $3.3 billion within the next 12 months.
That's the forecast. So it gives them and us a degree of visibility into revenue for the coming year.
But, and this is important, RPO isn't a crystal ball for product revenue specifically, is it?
No, not exactly. It shows the commitment, the contract value, but it doesn't perfectly predict when or how much customers will actually consume.
Because that consumption is what drives the actual product revenue number each quarter.
Precisely. Consumption is the real-time engine. Okay, should we pivot to profitability? We've got the GAAP figures and the non-GAAP ones.
Yeah, let's do that. Companies often show both. Why do they do that, generally speaking?
Well, the idea behind non-GAAP is to show sort of the underlying operational performance. It strips out certain items that might be one-offs or like stock compensation that aren't direct cash operating costs in the same way.
Right, to give a clearer view of the core business engine. So what did the GAAP numbers show?
Okay, GAAP. Product gross profit was $711.5 million. That's a 71% margin.
Yeah.
Pretty healthy on the gross level. But the operating line shows a loss, $447.3 million loss, which is a negative 43% operating margin. And the net loss was $430.1 million or 1.29 per share.
Okay, so significant GAAP losses. But what about cash flow? Sometimes that tells a different story.
It does here. Net cash from operations was actually positive, $228.4 million, about 22% of revenue.
And free cash flow?
Also positive, $183.4 million, an 18% margin. So they are generating cash even with the GAAP loss.
Interesting. Okay, now flip to the non-GAAP side. What does that picture look like?
It looks, well, quite different. Non-GAAP product gross margin ticks up to 76%.
Okay.
And crucially, non-GAAP operating income was $91.7 million. That's a positive 9% margin.
So an operating profit on a non-GAAP basis and net income?
Non-GAAP net income was $87.3 million or 0.26 cents per basic share.
And adjusted free cash flow, was that also higher?
Yep, $206.3 million. That's a 20% adjusted free cash flow margin.
So quite a contrast. What are the big things being adjusted out to get from GAAP loss to non-GAAP profit?
The reconciliation shows the usual suspects for tech companies. Stock-based compensation is the big one, over $400 million.
Wow.
Yeah. Then amortization of acquired intangibles, some acquisition-related expenses, restructuring charges, and they also had an asset impairment this quarter from exiting an office lease.
Okay, so taking those out paints a picture of, let's say, improving core operational profitability.
That's the argument, yeah. And they seem to be focusing on efficient investment.
How so? What are the trends there?
Well, that non-GAAP operating margin jumped from 4% last year to 9% this year. That's a pretty big improvement in efficiency.
So costs aren't growing as fast as revenue, basically.
Essentially, yes. Non-GAAP product gross margin dipped slightly, 77 down to 76, but the operating leverage is kicking in.
And the adjusted free cash flow margin, it was
Yeah.
20% this quarter. How does that compare?
It's lower than the 44% they had in the same quarter last year, which was unusually high. But 20% is still quite healthy, shows they're converting a good chunk of revenue into cash.
Right. Okay, let's talk strategy. The AI data cloud. That's their big vision, isn't it?
It really is. They frame it as this unified platform, an ecosystem for everything, data engineering, analytics, AI, apps, collaboration, the whole shebang.
And they emphasize the foundations, right? Fully managed, cross-cloud, secure.
Interoperable, governed. Yeah, all the things enterprises worry about, especially now with data scattered everywhere and AI raising new governance questions.
And data sharing seems core to this. They mentioned 39% of customers have a stable edge. What does that mean again?
A stable edge is basically an active data share or a native application share. So nearly 40% of customers are actively sharing or consuming data or apps across the ecosystem.
Which fuels that network effect they talk about.
And the marketplace listings are up to over 3,000 now, up 21%. More third-party data, more services available.
And are people actually using the AML features?
Seems so. They said over 5,200 accounts are now using Snowflake AML capabilities. So adoption is happening.
Okay, so the strategy seems to be gaining traction. What about the outlook? What are they forecasting for the full year?
For the full fiscal year 2026, they're guiding for product revenue of $4.325 billion.
Which would be what kind of growth?
About 25% year-over-year growth. So still strong growth expected for the full year.
And margins?
They're forecasting non-GAAP product gross margin around 75% and non-GAAP operating margin around 8%.
So similar profitability profile expected for the full year on a non-GAAP basis and adjusted free cash flow.
Expected around 25% margin for the full year.
Okay. And of course, we should always add the standard disclaimer. These are forecasts, forward-looking statements, subject to risks and uncertainties.
Absolutely. Standard procedure.
So wrapping this up, key takeaways, Snowflake's still growing revenue strongly. That's clear.
Yeah, both from new customers and, maybe more importantly, from existing ones spending more, shown by that 124% NRR.
The AI data cloud strategy seems to be resonating, judging by the uptake in sharing, marketplace activity, and AI features.
Right. And financially, while there's a GAAP loss, the non-GAAP numbers and the cash flow generation point towards improving operational efficiency.
Okay, so final thought then, something to chew on. We see this consumption model working. We see these million-dollar customers growing. They're generating presumably just vast amounts of data, especially with AI in the mix.
Right, the demands are only going up.
So how does Snowflake itself evolve? Does the platform need new capabilities? Does the pricing model need tweaks for these massive users? How do they keep serving these huge strategic clients effectively in the age of AI?
That's a huge question and maybe related.
Yeah.
Are the metrics we're looking at now, revenue, NRR, RPO, still the only ones that matter? As this AI data world explodes, could there be entirely new KPIs, new ways to measure success for a platform like Snowflake beyond just the financials?
What would those even look like? Data gravity, AI model training efficiency, ecosystem connections?
Exactly. Things we might not even be tracking closely today could become crucial indicators of their long-term dominance in this space. Definitely something to watch.